I did a video 3 years ago called How Much Is Enough to Retire Comfortably? It's one of my most watched videos ever, but after watching it back and reading the hundreds of comments, I reckon it's time for an update. So, here in the middle of 2024, how much is enough to retire comfortably? Hi, and welcome back to the channel. My name is Pete Matthew, and I'm a chartered financial planner based here in the UK. And this is the first of a series of videos going deep into investing towards and preparation for retirement. We're going to be looking at pensions versus other accounts, how it all works both before and at retirement, and we're even going to be talking about death benefits, which will be cheery. But I'll be keeping an eye on your comments and I'll aim to address all your questions as we go through. So what does enough mean? Well, whether you're early in your career or whether you're already retired, financial planning comes down, I believe, to income and outgoings. It's as simple as that. In retirement, most of us have less coming in than we're used to having. We're no longer earning a salary or running a business. So what incomes might we have coming in instead? Well, most of us will get the state pension, but not till at least 66 and likely later than that for most of us. For me, it's going to be 67, and that could get pushed back again before I get there. If we're lucky, we might have final salary or defined benefit pensions from our workplace, especially if you've worked in the public sector or for a large, long-standing company. We might maybe have rental income from a buy-to-let property or two, and maybe we'll do some paid work just to keep our hand in. These are all income sources, but maybe they won't be enough to cover the lifestyle that we'd like in retirement. And if our outgoings exceed our income, we're going to need to make up the difference from somewhere. And that's why we save and invest throughout life, building up assets to make up that difference. Assets? Well, things like savings accounts, ISAs, pension funds, investment accounts, places from which we can withdraw money when we need it. When the value of those assets are sufficient to sustain our rate of withdrawal for the rest of our lives, that's when we truly have enough. Now, obviously, there are a million variables here. Everybody's definition of a comfortable standard of living is different. We have no idea how long we're going to live. We don't know how much inflation will erode the value of our money. We don't know what investment returns might be. We don't know what future tax legislation will be. Although I think we can probably all agree that we're not going to be paying less tax than we are now, right? Fun fact, actually, I'm recording this the day after the UK general election, so we have some interesting times ahead. Some people will have incomes that are fixed, others will be indexed and will rise over time. Some may have a mortgage, others will have paid theirs off. Still others will be renters all their lives. And the further we are away from retirement, the further into the future it is, the less clear things are going to be. So can we agree that this is all, at best, educated guesswork? If we can, then that's great. I'm going to illustrate how I think about how much is enough by using my own circumstances as the example. Now, because we may be trying to arrive at a number which is in the future, and the future is by definition unknown, we're going to need to resort to assumptions and to rules of thumb, like the 4% rule. Now, this rule, which isn't really a rule at all, says that you should be able to draw 4% of the value of your savings, investments, and pension funds each year, and it will last the rest of your life. So in that case, you need to work out what you're going to need in 1 year, and then divide it by 4%, or another way to achieve that is to multiply it by 25. So if I want to spend £10,000 a year, then I need 25 times that, 250 grand, in my portfolio. So first we need to identify the income coming in. And we need to do this assuming that we're retiring now, having worked as long as we plan to. So I'm 49 now, I know I look it, and let's just say that I want to retire when my state pension comes in at age 67. Well, I will have a full state pension by then, and in today's terms, that's £11,500 a year. So does my wife, actually. So between us, that's £23,000 a year in today's terms. Jo has a tiny NHS pension, which will bring her about 500 quid a year in today's terms. And for us, that's it for guaranteed income sources. I don't have a defined benefit final salary pension. We don't have a rental property. So that's £23,500 a year, or just over £1,950 a month between us. And that should be tax-free. Certainly will be under current rules, but as I say, we don't know about future tax rules. Now, we could easily get by on £2,500 a month spending. But let's say we want to live well in retirement and we want to spend £4,000 a month. Well, the shortfall between our income and our desired expenses is £2,050 per month, or $24,600 per year. If we multiply that number by 25, you get a figure of 615,000. That's my number in this example. A pot of money that big in today's terms should be able to supplement our pension income indefinitely and provide for our desired lifestyle if the 4% rule is borne out. Now, two things to mention. A few times there I use the phrase in today's terms. We can only think in today's money. So find out what your state pension is if you were to reach state pension age today. If you have a defined benefit pension, find out what it would pay today if you were at normal retirement age. We just can't think in future money because it's meaningless to our present day, our current minds. But inflation is obviously going to increase our costs by the time we get to retirement. We can allow for that by assuming that our investments grow in excess of inflation, though. The other thing to mention is tax. So in the example earlier, I said I need to draw £2,050 per month. And if I draw it from my pension fund, that's going to be taxable, at least in part. So to end up with £2,050, I'm going to need to gross that up to the pre-tax figure. Now we gross up for 20% income tax by dividing by 0.8. And so for me, that means I'm going to need to draw £2,562 a month, or $30,750 a year before tax, so that I get what I need to spend after tax. Now, if I multiply that figure by 25, my number isn't 615,000 anymore, it's £768,750, much higher. Now remember, you don't pay tax if you draw off your ISAs, or if you use tax-free cash from your pension, or if you spend money that you got in the bank. So grossing up for income tax on all of it is a worst case scenario, I reckon. So we're getting pretty deep here, but if this is helpful so far, please hit the like button and subscribe to the channel if you're not already. This is the first of a series of videos about building towards retirement and financial independence as we head towards video number 500. And there's some cool stuff to come, including a retirement readiness scorecard. So subscribe to the channel and stay tuned for more about that. Right, remember I need £768,750 in capital at age 67 to sustain my chosen lifestyle, based on needing to draw down £30,750 a year before tax. But of course, I'm going to need much more than that in pounds terms because of inflation. Now, I'm 49 now, and I'm calculating to age 67, my state pension age. So I've got 18 years to get this right and to build this money. Now, if I assume inflation of 3% over 18 years, then my target of £768,750 has turned into, say it quickly, £1,308,745. Now, fortunately, I'm not starting from scratch, so let's say I've got 200,000 quid amassed in ISAs and pensions already. But still, if I assume growth at 3% above inflation, I'm going to need to save an extra £1,936 per month to hit my target. By the way, I'll put links to the calculators I use to arrive at these figures in the description. Now, that's a lot of money by any measure. And when you run your numbers, you might just think it's an impossible task, what's the point, throw your hands in the air and give up. But please don't. Remember, I've assumed that I'll have to pay tax on all that extra withdrawal from my pot, and I probably won't if I'm smart by using ISAs as well as pensions. If I assume that I won't have to pay tax at all, my target comes right down, and so does my monthly savings, from £1,936 a month down to £1,249 a month, about a third less or thereabouts. Still a lot of money though, so how do we give ourselves the best chance of hitting these targets? Once you know how much you have to save each year, there are a few things you can do to get there as efficiently as possible. Firstly, use all the tax breaks that you can. Pensions are easily the best for this. You get tax that you would have had to pay anyway redirected into your pension instead. And if you're employed, you get money from your employer too, so it's definitely important to put pensions to good use. If you're under 40, open a lifetime ISA and pay as much as you can into that, up to the £4,000 a year, because this comes with a bonus from HMRC of up to £1,000 a year, as long as you only use the money to buy your first home, or as we're talking about here, retirement after age 60. Remember though that you can only pay into a lifetime ISA until you're 50. Invest aggressively with a high allocation to global equities. If I assume a 5% above inflation return rather than the 3% I assumed earlier, my monthly saving amount is nearly halved. So invest aggressively. It's going to be a rocky road, right? But the growth will follow given enough time. And I have tons of stuff about investing on the channel here and on my website, so check it out. Now, if you've done your numbers and you realize that actually you can't afford to save what you need each year or each month, that's okay. You've got to start with what you can afford and work up from there. And that means you have to find a figure that is manageable but slightly uncomfortable to save and invest each month. And then commit to reviewing it after 3 months and try and put it up, even if it's only by £5 or £10 a month. Do this every 3 months until you just can't push your savings rate any further. Also, commit to saving most, but not all, of any pay rises or bonuses that you receive. You have to still live for today, but we need to have a mind towards tomorrow as well. Once a year, recalculate and review things. Do the sums to work out your number again. Maybe it's gone up because you realize you want to spend more when you retire. Or maybe you realize you can get by on less, and so the number comes down. Maybe even your retirement age can come down for the same reason. Look, when we're talking about long time scales, the numbers can be scary because we can only think in today's terms. But this exercise is worth doing because at least then you have a target to aim at. You're not just saving as much as you can and hoping it'll be enough. Also, by setting yourself on a definite course towards retirement and putting in place the regular savings and the investment regime to get there, you can then start to think about how you retire, what you're going to do when you get there, how you make the transition, all that sort of stuff. Next time, I want to dig a little deeper into the levers that you can pull to accelerate your progress towards your goals. And I got a bunch more videos in the coming weeks about this subject. How you can get your head down and build wealth for the long term and head towards retirement. So subscribe to the channel if it's been helpful, stay tuned for those coming videos, and thanks for watching this one.